Let's take a look at your market news now. Asian equities rallied and the dollar extended losses after the Federal Reserve signaled it would slow down its pace of interest rate hikes, providing some much-needed respite to investors fretting over the cost of borrowing. Now, dealers are also keeping an eye on top-level talks between China and the United States. Those are aimed at resolving their long-running trade war, which kicked off on Wednesday. Now, green across the board, with the Nikkei rising over 1%. The Hang Seng was 0.8% to the good, while the Shanghai Composite picked up 0.6% to 2,590 points. U.S. stocks ended sharply higher on Wednesday after the Federal Reserve said it would be patient in lifting borrowing costs further this year, reassuring investors worried about a slowing economy. A much better trading picture in America last night, with the Dow Jones Industrial Average picking up 1.78% to close at 25,016 points. The S&P 500 moved over 1.5% to the good, with the S&P hitting 2,681 points. The Nasdaq Composite was the biggest gainer, moving to 7,183 points, rising 2.2%. For more on the markets, we cross to Arabile Gumede, who's at the Johannesburg Stock Exchange. Good afternoon, Arabile. What's happening on the markets today?
Good afternoon to you, Nzinga. Well, of course, the market today has recovered somewhat and now gone into some green territory as well. 0.4% to the good at the very least, even as much as 0.5% there. So a slight recovery following through from yesterday. The likes of ShopRite doing much better and coming back ever so slightly as well. So some positivity coming through. It seems that the global sentiment today is a little more positive as well, following Jerome Powell's decision not to hike interest rates, of course, in the United States. And that picture itself may not change for the remainder of this year. But with that, let's unpack exactly what those markets are looking like. Here are the numbers of the European and local markets. Much better mark there for the rand, as you can tell, of course, at 13 rand 33 against the US dollar. So it's all significant and all really important as we take a look at what is moving markets. Chris Gilmore, independent analyst, joining me now as we unpack that picture. Chris, thank you so much for the time. A much better picture today, 0.4% up for the JSE, recovering from yesterday's fall. But that was mainly ShopRite, wasn't it?
Was indeed. And I see on the board that ShopRite's up a little bit today, 4% up, but it's still nowhere near where it was. And I think, as we were saying earlier, I think it's reflecting, and I know there are certain other technical factors involved, but I think it's reflecting an extremely poor consumer background.
Yeah, and that must certainly hurt. I mean, all the other retailers seem to have gone up as well today. The likes of Foschini Group, the likes of Mr. Price as well, doing fairly well. Does that sentiment, do you think, sustainably sort of go through the year? Or do you think it, and is it fully dependent then on the growth picture, or is there perhaps a recovery in place?
Look, at the end of the day, you have to ask yourself, what is a reasonable price for these retailers? And in my almost 40 years of analysing retail stocks on the JSE, I have never seen anything like this wipeout. And I use the word wipeout advisedly, that's taking place currently. It's utterly appalling. In the old days, you used to get certain companies, like, for example, ShopRite, which is considered to be defensive.
Yes.
So a food retailer, you know, it's non-discretionary, and they would do relatively well compared with the much more discretionary expenditure type companies, like the clothing and footwear and the household goods and furniture, that type of thing. This time it's across the board, and there are one or two exceptions. Pick n Pay, you know, had a big reduction in headcount a year or two ago, so that certainly helped them. But if you look at the margin at Pick n Pay, I mean, it's minuscule. I mean, 1.5% to 2% is nothing.
All cyclical, though, isn't it? Should be riding that wave.
Yes. And so, unfortunately, I have this horrible feeling that we're going to grind along the bottom for a while. So to answer your question, are we going to see any kind of vigorous upturn? I think not, because it's all dependent. It's all predicated upon a return to growth. And in turn, growth in a holistic sense is largely dependent on the consumer. You know, mining is looking pretty dodge. Manufacturing is nowhere. So it's up to the consumer, as it has been for quite some time. So if the consumer's tapped out and there are no signs that that's turning, then unfortunately I think the same goes for the whole sector.
Yeah, such an unfortunate picture on that front. But it all, I mean, the market itself doing a whole lot better, including the rand moving right through to around 13.30 against the US dollar. That's primarily because Jerome Powell decided, nope, the picture in the US is not as rosy as we thought it is, and we aren't going to hike rates for some time by the seams of things.
Yeah, no, I think that's right. And up until October of last year, Jerome Powell was singing a very different tune. He was talking confidently about having 3 or 4 interest rate rises. Then all of a sudden, I think he thought, this American economy is not nearly as robust as we initially thought it was. Maybe we'll see some nice results coming through from the US corporates when they start their program, the season next week and beyond. But I'm not holding out too much hope for that. Even if they do, and again we were discussing this earlier, a lot of companies in the US have not taken advantage of the tax cuts that Donald Trump has given them to lay the foundation for future growth. No, they've gone for a rather avaricious approach, where they've gone and they bought back their own shares, which in turn has helped to kind of keep the market up. So, look, I think we're now looking at a situation where Q3 and Q4 in the US, as the year progresses, is not going to be looking nearly as bright as it is now. And therefore, I think Powell is seeing that, and he's sending the message out now.
Yeah.
So don't get too enthusiastic about what's going to happen in the US. And unfortunately, we're largely driven by what happens in the US.
Yeah.
So if we're not going to be looking at a particularly robust US market, then what's going to drive our market? Unfortunately, with the kind of tepid growth that we're likely to see this year.
And other factors that then begin to influence that in terms of growth become Brexit and that trade war, which is affecting China as well, as you can see by that picture.
Absolutely. So China, even if you believe their figures, the trend is still downwards. So, you know, once you get into 2020 and beyond, a thing called the Lewis turning point kicks in China, which means that the big growth vector, which was always the movement of people from the rural to the urban areas, that's long ago died out. So it's progressively more and more difficult for the Chinese to keep growing, and again from this progressively higher base.
Yeah. Okay. So overall, then, market picture for the remainder of the year, your sentiment, your sense. A slight bit of negativity. I mean, January seems to have held out quite well, comparatively speaking. It's one of the better Januaries, even for the currency as well. You know, moving from 14 Rand and now well into the 1330s. Do you see perhaps some sort of, even if it's small, of positivity for the year? Well,
look, if we take the currency first of all, I'm not going to go out on a limb and try and forecast currency. That's a real mug's game. And it's going to be very much dependent on policy, you know, what happens in the political arena. Yeah. And there's an awful lot of latitude for things to go wrong, you know. So, touch wood, things are actually going reasonably well at this point in time. And hopefully that will stay beyond the elections, up to, including, and beyond the elections.
Of course.
As far as markets are concerned, you know, it's been a long bull market that started in March 2009. Are we even in a bull market anymore? What happened in January, you came off a very, very low base on Christmas Eve.
Yes.
So you bounced off nicely from there. But beyond that, I think, again, it's probably going to be data dependent as well. Are we going to see the kind of results that are really going to push the US markets higher and because of that, markets in the rest of the world? We wait to see. Yeah.
Tough picture indeed. Look, for today we'll take it, a little bit of green, and we'll unpack that and see how the market fares across the world, the year, of course, and we'll be right here on SABC to, of course, give you that data as well. That's Chris Gilmore, independent analyst, joining me as we unpack that market picture. For now, that's where the buck stops, however, Nzinga joins you right after this short break. Do stay tuned.